U.S. natural gas price volatility and structural energy market dynamics. Introduction. Volatility as a structural feature of energy markets. Energy markets are not merely economic instruments, they are geopolitical instruments. Macroeconomic, transmission channels, and technological battlegrounds. Natural gas markets, particularly in the United States, demonstrate extreme sensitivity to exogenous shocks such as climate variability, geopolitical tension, and infrastructure constraints. Embedded in derivative markets. The recent collapse in US natural gas futures prices, placing them on track for the largest percentage loss in nearly 3 decades, is not an anomaly but rather a predictable outcome of structural characteristics embedded within commodity markets. The interaction between weather forecasts, algorithmic trading, supply elasticity, and geopolitical risk premiums produces nonlinear price dynamics that amplify both upside and downside volatility. US gas production reached 111.6 billion cubic feet per day as supply recovered rapidly after winter. Highlighting the speed at which technological and logistical resilience has improved in modern extraction environments. The implication is that traditional scarcity driven price hikes are increasingly moderated by flexible shale production capabilities, though this flexibility itself introduces new instability by compressing the time horizon between supply shock and market correction. Structural derivatives of natural gas price movements. Natural gas pricing behavior is primarily driven by four structural variables, which are demand variability driven by temperature fluctuations, storage dynamics relative to seasonal expectations, and production elasticity enabled by shale extraction technologies, as well as financialization of commodity markets through derivatives and algorithmic trading strategies. The convergence of these forces produces rapid price movements that may appear irrational to observers unfamiliar with the embedded expectations market incorporate into pricing mechanisms. Weather-driven demand shocks remain the most immediate catalyst for price changes. Natural gas consumption is strongly correlated with heating degree days, a statistical measure of heating demand intensity. A shift in temperature forecasts can materially alter consumption expectations, triggering rapid adjustments in future contracts as traders reprice expected demand in rapid liquidation of long positions and accelerated downward price movement. Production recovery also plays a decisive role. Freeze off temporarily constrains supply by disrupting extraction and transportation infrastructure. Once temperature normalizes, production rebounds quickly, often overshooting equilibrium levels due to pent-up operational capability. The rapid restoration of output in its prolific basins such as Permian Basin have increased the responsiveness of supply to short-term disruptions, thereby compressing price cycles and increasing short-term volatility. Financialization and algorithmic implications. Commodity markets are no longer purely physical markets, they are financial markets layered on top of physical supply chains. Algorithmic commodity trading advisors operate based on momentum thresholds, volatility signals, and statistical arbitrage strategies that react automatically to price changes. When prices reach technical levels, automated strategies trigger cascading liquidations or short positionings, amplifying directional moves beyond that what would be justified by fundamentals alone. Algorithmic trading advisors increase short net exposure as prices decline, illustrating reflexivity in financial markets, where price changes influence positional decisions, which in turn further influences prices. This recursive feedback loop produces overshooting behavior that may temporarily disconnect prices from underlying physical fundamentals. Financialization increases liquidity, but it also increases fragility. Liquidity provides withdrawal when volatility increases. Widening bid ask spreads and magnification of price swings. In energy markets where storage costs and logistical constraints prevent instantaneous arbitrage, those price swings can persist long run. Those price swings can persist longer than in other asset classes, geopolitical risk premium, and strategic signaling. Energy prices incorporate geopolitical expectations as embedded risk premiums. Statements indicating potential negotiations between United States and Iran reduce the perceived probability of supply disruption in global oil markets, which exerted downward pressure on commodity prices broadly. This demonstrates that commodity markets function as probabilistic forecasting mechanisms for geopolitical conflict. Risk premium represents the market's attempt to price uncertainty regarding supply disruptions, sanctions, military conflict, and trade barriers. When perceived risks decline, speculative positions accumulate in anticipation of scarcity are unwound rapidly, producing sharp downward corrections. Geopolitical expectations operate asymmetrically. The market tends to price in risk gradually but removes risk premium rapidly once uncertainty declines. This asymmetric contributes to the magnitude of price corrections observed in commodity markets. Supply elasticity and shale revolution. The United States shale revolution fundamentally altered the elasticity of global hydrocarbon supply. Horizontal drilling and hydraulic fracturing technologies enable producers to adjust output relatively quickly compared to conventional fields, reducing the duration of supply shocks. However, increased elasticity introduces new volatility regimes characterized by shorter but more frequent price changes. High frequency supply adjustments produce dynamic disequilibrium conditions where production decisions respond to expected prices rather than current prices. Producers hedge future output using future contracts, introducing expectation based feedback loops that shape production planning. Elastic supply reduces the long term effectiveness of geopolitical supply constraints as tool of strategic leverage. While OPEC historically exercised pricing power by coordinating production quotas, decentralized shale production introduces competitive supply responses that weaken cartel pricing discipline. Weather as a market variable. Unlike many economic variables, weather introduces exogenous shocks that are largely unpredictable beyond short range forecasting horizon. Natural gas demand is particularly sensitive to temperature deviations because heating demand constitutes a significant share of consumption during winter months. The reduction in expected heating degree days altered projected demand trajectories, leading traders to adjust forward price expectations downward. Weather derivatives and predictive analysis attempts to quantify these risks by forecasting errors remain substantial, contributing to persistent volatility in energy markets. Weather sensitivity introduces seasonality into pricing behavior. Storage levels accumulate during low demand periods are drawn down during high demand periods. Deviations from seasonal norms create price dislocations that attract speculative capital seeking arbitrage opportunities. Strategic implications for energy security. Energy markets operate at the intersection of national security, industrial policy, and financial stability. Natural gas price volatility influences electricity costs, industrial production expenses, and household energy bills. Governments monitor energy price stability as a macroeconomic stable variable. Because inflation expectations are sensitive to energy price movements, rapid declines in natural gas prices may reduce inflationary. Sustained low prices may lead to underinvestment, increasing the probability of future supply shortages and price spikes. Energy security strategies therefore balance price stability with investment incentives. Strategic petroleum reserves, diversification of supply sources, and investment in renewable energy technologies represent attempts to reduce vulnerability to commodity price shocks. Market psychology and expectations formation. Commodity markets reflect collective expectations regarding future supply demand balances. Price volatility often reflects shifts in expectations rather than changes in current physical balances. Traders interpret weather forecasts, geopolitical developments, production reports, and macroeconomic indicators to inner future price trajectories. Expectations formation is influenced by narrative structures. Market participants construct casual narratives linking events to price outcomes. When dominant narratives shift, price adjustments can be abrupt. The transition from a narrative emphasizing winter scarcity to a narrative emphasizing production recovery illustrates how expectations transition produce discontinuities in price trajectories. Long term Structural transition in energy system. Natural gas occupies an immediate position within the broader energy transition from fossil fuels towards renewable energy sources. Gas is often positioned as a bridge fuel due to low carbon intensity relative to coal and oil. However, long term demand expectations are influenced by decarbonization policies, technological innovation in battery storage, and electrification trends. Volatility in natural gas may accelerate investment in alternative energy technologies by increasing the perceived risk associated with fossil fuel dependence. Energy transition dynamics and therefore interact with short term commodity price fluctuations. Capital allocation decisions within energy markets increasingly incorporate regulatory risk associated with carbon pricing regimes and environmental policy shifts. Conclusion. Volatility as an information mechanism. Natural gas price volatility should not be interpreted solely as an instability but as an information transmission mechanism reflecting evolving expectations about weather, geopolitics, and technological capability, macroeconomic as well as macroeconomic conditions. Price movements encode probabilistic assessments of future supply demand balances. The rapid decline in natural gas futures illustrates the speed at which modern markets incorporate new information. Advances in extraction technology, algorithmic trading, and data analytics have compressed the time required for markets to adjust to changing conditions. Energy markets remain characterized by structural complexity arising from the interaction of physical constraints, financial instruments, and geopolitical strategy, as well as technological innovation. Understanding these dynamics requires interdisciplinary analysis integrating economics, political science, engineering, and behavioral finance. The recent price movement, therefore, represents not merely a transient fluctuation, but an observable manifestation of deeper structural forces shaping global energy systems.